What do you have against the SAFE?
I don't have anything against the SAFE so much as that I think the SAFE is starting to look more like a price round anyway.
Hello, everyone. Welcome back to the Carta Data Minute podcast. I'm your host, Peter Walker, head of insights here at Carta. There's been a lot of talk lately about the chasm that's opening up between seed stage startups and those that actually make it to Series A. There's a whole glut of companies who seem to be stuck in the seed plus, seed extension realm, and they're just not able to break through to the Series A realm. So today I was incredibly fortunate to talk to Kate Shillo Beardsley, one of the founding partners at Hannah Gray, an early stage investment firm. They invest into pre-seed and seed companies, anywhere from, say, $300,000 to $1 million checks. And Kate is a fascinating person. I mean, she was Martha Stewart's chief of staff back in the day, and she's held venture jobs across many different funds over the last 15 years. One of the smartest people that I know that thinks about the theses that are going on at early stage investing. She was a great person to talk to about exactly this data chasm that's opening up between seed and Series A. But we touched on a whole lot more than that. Kate and I spoke about a lot of different subjects, including how investors analyze trends and invest into sectors while other generalist funds will establish theses about the world and use those macro theses to decide which investments to make. We spoke for a while about Kate's preference for priced equity rounds. She actually unlocked something for me in the debate between priced equity and safes that I hadn't really heard before. An idea about backstopping your optionality as a founder using a priced equity round, especially if you don't end up going the distance and making it to $1 billion company. I mean, I thought this was a fascinating response. The very first time I've heard this approach to priced equity. We also touched on a few things about AI, of course. We touched on founder DNA being more important than location. And we touched on which investments most fascinate her at the moment. This was a jam-packed conversation. Let's jump into it. Kate, thank you so much for being here.
Thank you for having me. This is awesome.
It's so great that you could fit us in right before you head back off to Denver.
Yeah,
we appreciate it.
Mm-hmm.
These conversations are always just better in person.
Yeah, no, I really appreciate it. And I love coming to San Francisco. So thanks for having me.
Were you, how long were you here?
Just a couple of days. Jessica, my partner, is in New York. I'm in Denver. Michael on our team is in Los Angeles, and Haley's in North Dakota. So we are fully distributed. And so it's really nice to have these excuses of, okay, let's go together. And so we try to do team trips at least every couple of weeks, at minimum the whole team every quarter.
Meet a bunch of founders wherever.
Yeah, it's always that combination of like, we had lunch with one of our founders who's headquartered here, which is, again, really nice to just see people in person.
Yep.
And I think teams obviously from 2020 on are starting to be distributed first. So you have to sort of make a point of have these giant lists of, I'm going to Austin. Who do I know in Austin, both on our LP side or co-investor side or founder side or perspective. So it's just a constant list of, okay, who's available.
Are you all dumping that into like a single CRM and trying to track it?
Oh my God, we have so many CRMs here.
That's probably not effective.
No. No, but it's helpful because like you can search across them, but it's very specific around what things what relationships we're tracking.
Right, yeah, that makes sense.
But it's helpful.
Well, wanted to give you a chance to just intro Hannah Gray as a firm before we jump into some of like the early stage fundraising data that we wanted to talk about today. But so tell us a little bit about Hannah Gray.
So Hannah Gray, we're a pre-seed seed venture firm investing across the country and really thematic focused. Always, I think with pre-seed and seed, you have to be very much team driven, founder driven. Mm-hmm. So we try to spend a lot of time educating ourselves around specific sectors, movements in the market, macro or micro. So we publish something called Culture Vibrations. We spend a lot of time developing theses so that we can be ready when founders are coming to us and saying, okay, like I'm working on something in this category, but it crosses over to this category and it's important now because insert AI or whatever the new factor is.
Sure.
And so we really look for customer obsessed founders that I think can translate into anything from B2B to B2B2C to D2C. We just want to make sure that our founders really, really understand their customer set. We certainly lean in with them in that category to help understand and get them their first substantial revenues. But that's what we're all about, is really just how can we be your early team and focusing on that, go-to-market strategy, which is what they're all trying to figure out in terms of product market fit.
Can you give me a little bit of an example and the difference between a thesis or a thesis and a sector.
Yeah.
So there's a ton of funds that we know that are, hey, we are a biotech fund.
Yep.
That is the sector we invest in. What's your sort of particular perspective on that?
Yeah, I think I've been in venture 15 years now, managed 5 funds and seen a couple cycles. And there's definitely funds that go out that have sector specific strategy, right? Their expertise is in fintech,
right,
healthcare, et cetera. And they kind of either decide there's a verticalization of that strategy and they might play in a certain category because they have customer relationships or partnership relationships and then they can kind of go against, I'd say, different payer strategies, player strategies, et cetera. But they understand sort of the plumbing really well of those categories. We think about that too, but oftentimes there's ebbs and flows, especially at being an early stage investor, of things that kind of fall in and out of favor. And that can be for a number of macro, again, reasons. And so we want to make sure that we're sitting in something where it's like, okay, there's a theme coming across our desk. We're continuing to see patterns of X. How is that going to affect a certain customer set? And where would that best be applied? Fintech, healthcare, enterprise SaaS, manufacturing,
Right.
I'm just naming areas where you're like, let's look at this general trend.
Right.
And trends, and I'm using that word, but it sounds more abbreviated. Trends, the way we think about it, are really movements across what could be a decade, because you have inclinations of something, but then applications of it could take several years to actually start to see the results of said trend.
Right.
So we really want to make sure as pre-seed and seed investors, we're watching some things like a wave start to crest. And we want to make sure that we're seeing where we can best apply that with a very, for lack of a better word, capitalist mentality of like, where's the most money going to be generated out of said trend?
Sure.
And sometimes those trends can be spotted at the consumer level, right? They're potentially looking for workarounds in certain areas. And how does that start to be, I'd say, more fully fleshed out when you look at a B2B application of said trend? And that could take anywhere from 1 to 5 years for that consumer trend to move up the channel to business trend.
So how do those trends come across your transom in the first place? Are you and Jessica just out trend spotting as most of the time?
Yeah. I think that's the thing that I've realized over the decades of doing this is my background's actually in media, Jess is in marketing as well. And so a lot of what we were kind of trained to do in the business world on the operating side, I worked at Martha Stewart Living Omni Media, and then I was an early employee at the Huffington Post. I actually helped Ken Lear, who's the founder of the Huffington Post, teach a class in journalism at Columbia, back in the day, which is amazing. So there's that mentality, right, of discovery journalistic reporting mentality. Michael on our team, who's also fantastic, came from Publicis. So there's this know-how around advertising, marketing, media making, and oftentimes a lot of that is trend spotting. So we're using our muscles and our skill set and our research background to be able to say, let's go look at the early indications that we were sort of trained to look for, figure out how to package that. And it's not to say that also turns into a thesis right away. It's more along the lines of let's watch, listen, and learn and see what's evolving, because you can have trends that go nowhere, theses that you really want to have happen, but then sit on a shelf. So it has to be this idea of what are we seeing bubble up against the surface that could be applied? So absolutely. So we publish something called Culture Vibrations, which is a quarterly report. We share it with our LPs. We have it published on our website. Anyone, founders, you can all go download and look at it.
You should.
Yeah.
It's a good read.
It's really, we also want it to be a journal that would be something we'd be excited to read. So it's beautifully done.
Agreed.
And it reminds me of our magazine days.
It looks like it takes a lot of work.
It does, but it doesn't, because we know what we're doing. And the same point, we want something that, again, encourages a conversation with entrepreneurs and co-investors and limited partners around, again, what are you seeing that's interesting, right? How many times do you have those conversations where you're sitting down with someone at a group lunch or a one-on-one or a quick call, and they're like, tell me what you're seeing, you know? And you're like, okay, well, how do we distill that in a very easily communicated way? And so Culture Vibrations kind of does that for us. And it's a muscle memory that we like to have kind of always at the ready, because again, we need to make sure that we're meeting entrepreneurs where they are, where we're having those same thoughts. And so they're saying, let me tell you a world where AI exists over here in manufacturing. And you're like, we've actually been thinking about it in this application. So it's very cool to hear, and again, that's a heartier conversation than just sitting back and being educated for half hour, 45 minutes to the founder of saying this is the first time I'm hearing of this. So again, it's that be ready state.
And so do you have founders that come to actively pitch you and try to fit their idea into a theme that they know that you're already interested in? Or is it more that the pitch seems to align with something that in the background you've been thinking about for a while?
I think it's both. It's definitely starting to be, I'm seeing more who are reading Cultural Vibrations and saying like, I'm so glad you published this. I'm working on X, which is lovely. But I think it's more the latter of what you just said, is that, again, we're meeting them and we're like, we're the ones pulling it out and saying, we think that's interesting because we've been reading this, or we've been hoping something would go over here. How are you thinking about that?
Right.
But yeah, I think it's always going to be a myriad of ways.
Definitely. Okay, so 2 more questions on Hannah Gray as a firm specifically. One is on leading versus following. So you say you lead or co-lead the first institutional round into a lot of these companies. Why do you lead? And then 2, when it comes to founders, I am hearing a lot of people who are saying, look, I'm getting some decent conversations and traction with VCs, but they're always saying you need to find a lead first before I will follow on. Or even sometimes the reverse, which is I don't want to lead. And so it kind of leaves them in this sort of abyss where they're just kind of like, where I can't find the lead and I need the lead to get the other people. The other people won't help. I kind of feel stuck. So how do you approach those conversations with founders?
Absolutely. I think that's why we designed the firm to be, so we're on a fund one, $51 million. We wanted to be large enough to lead, to help push through that conversation. Again, I've been doing the pre-seed and seed, or what it used to be called Series A when I started investing, but now the terminology has changed. But the idea is that it was the earliest juncture where you would start to take institutional capital. And so if we're feeling the confidence in the investment, the opportunity, we absolutely should have the, wherewithal to be able to put down a term sheet. And I mean, again, I've been seeing a couple cycles where this is not a new trend. In 2010, when it was pencils down, New York City, where I was headquartered starting Lyra Hippo, traditional institutional investors were like, this is not a good time. We're just going to pause. And so that always made room for new funds like ours to say, okay, well, we're going to stick our neck out. And we weren't large enough to lead at the time in that first fund, but we had conviction to say we're investing. And I think leading with conviction, and it's not just conviction, it's the willingness to do the diligence, it's the reference calls, it's putting a package together that speaks to the confidence of why you think this opportunity is good. And we're really transparent. We share that with other investors that are coming through because we think of this as a team sport at this stage. We're not looking to take the entire round ourselves. We know that we have one certain skill set that we just talked about in terms of go-to-market strategy. I'll give another instance. There's another company that we just backed that's focused on manufacturing. The co-lead investor and the lead investor, they focus on a manufacturing only. A lot of the companies in their portfolio just look like this one company, but we bring a different skill set. So the company is just going to have that much of a greater chance when you multiply different skill sets coming to the table. So we designed our firm to lead or co-lead, to be, again, collaborative with other funds that are similar check size. And I think that that's something that a founder can take to other investors, especially maybe smaller specific angel groups or smaller checks, with confidence and saying, Hannah Gray is going to lead. These are the terms. You can talk to them. They'll share their diligence. And I think that that's where we want to be with the companies. Again, we're trying to meet the founders where they are. So it speaks to a stronger process for them in closing, and no founder wants to be out there fundraising forever.
It seems like a lot of them are kind of stuck in that no man's land.
Totally. But it's honestly normal in these trends, right? We're seeing a bit of a slowdown downturn. It's not any different from 2014 or 2010, where it was like, gosh, it's really hard to fundraise. And you're like, yeah, but people are getting it done.
It happens.
Yeah.
Or it doesn't, I guess, in many cases.
Yeah.
But you're right. Yeah. So it's, do you rather that founders come to you as the first pitch, or would you say is it better for them to have lined up a lot of follow-on investors and then saying, look, we only need a lead? That's like the last piece in the puzzle.
I don't think that matters to us as much because we're so, I'd say, more dogmatic around thematic strategy, and we are trying to suspend belief that this team, this idea now, et cetera, has an ICP that they can go after. We're spending more time trying to understand their vision and our belief in that vision of why now and how they could execute on that based on the amount of money they're trying to raise. What do they think, how long that's going to last them? How long is it going to take them to actually go through the pilot phase? We're spending more time on that, less time on like, well, how competitive is your round right now? We have done things where we're the last check-in, but that's just when we met them. We've done opportunities where we're the very first pitch they've had and the new idea. I think it's just, we try to move quickly, but I say quickly with air quotes here, is that that really looks like a month, from that first initial meeting through.
That's pretty quick.
I think so.
Yeah.
But also when you're looking at this, we're committing to each other for what could be a decade or longer.
Yeah.
A month of courting, getting to know each other is really not long. But I think that's another thing that founders need to stress is, yes, you want to move through that process. You just want to make sure it keeps moving every week. Like, you know, we're tracking down milestones, but that's the fastest we've completed diligence from initial meeting to close. It's probably
that's
more
pretty
likely.
quick.
Yeah.
But I agree with you. I don't think that the idea that you would get to know each other a little bit before jumping into this decade-long process, it makes a lot of sense.
Yeah, but think back to 2021 where they're like, I'm going to give you till the afternoon to make a decision. And you're like,
well, unfortunately, I think that to continue the marriage metaphor, might result in some more divorces than we would expect on a natural basis. So, okay. So last question on Hannah Gray, which is a preference, as you state on your site, a preference for priced equity.
Absolutely.
What do you have against the SAFE?
I don't have anything against the SAFE so much as that I think the SAFE is starting to look more like a price round anyway.
Sure.
I remember when SAFE started showing up and I was like, I remember when notes started showing up and I was like, and it's just a movement to obviously ease of close, founder-friendly terms, et cetera. We're not against any of those things. The thing that I think gets a little loosey-goosey and dangerous for the founders is we're of the mindset where we want founders to have leverage in all instances. Even though we're negotiating against them on the opposite end of the table, we know that it's better for them, their ownership, their team, to be able to have leverage in any negotiation, whether it's against us or other, general partners down the road. How do you do that? And one of the reasons why equity is so crucial is one, you'll start to understand what you own. Mm-hmm. We're probably by the time that we've met a founder, they might have already done a SAFE on a friends and family experience or a note, or maybe even several at that point, depending on how long they've been doing this or, whatever the makeup is of their cap table. So we want to make sure that if we're going to spend the time on diligence, we're going to bring a syndicate together. They're raising more than $2 million. That is a good time to take a moment and say, I'm going to put a stake in the ground and make sure I understand what I own. Yeah. Because if we were looking back in 2021, 22 seed rounds or pre-seed rounds, they were, pre-seed rounds were $5 million. Yeah. And to have maybe 3 safes before you raise that $5 million that came relatively quickly, and then just get back to work and then you're stacking safes at that point. Yeah. And even if you're an experienced entrepreneur, it's a really murky area of what do I own? What have I diluted myself to? I mean, there were instances where we were cleaning up multiple stacked safes where it was a pre-money and then a post-money, and then the lawyers are sitting there saying like, this is a mess. And the founders are frustrated because they didn't realize what they were necessarily pulling down. And it was so easy for a founder to just pull down the document and say like, I'm just raising on this and just doing rolling closes. So it also speaks to the behavior of appreciating what venture capital will ask of you downstream. And if, you raise say $2 million in a pre-seed round and you had safes before, we helped you close it up. But then you needed a bridge, right? Or just $1 million or $2 million after that, but you didn't really want to go out and raise your official seed round. Okay, a SAFE now makes sense because it's backed up against a seed round, a price round.
Interesting.
A pre-seed round. The other instance if you have to think of the negative terms too, if you're not achieving product market fit, let's imagine you're an AI company right now, big dream, able to raise, you closed a price round on a $3 million round, you then had a SAFE. You now have an offer to be acqui-hired because you have a great technical team. Your negotiations are going to go that much better because you have an equity backstop that you can sit there and push forward to versus I have 4 stacked safes that I've just, in order to close very quickly. Right. So again, you as a founder have leverage in a negotiation conversation versus the suggestion of equity, which is a SAFE ultimately. Yeah. So it's a little bit more of a technicality, but I think it speaks to the education and the nuance for the founders down the road.
I think the point, especially around certainly the understanding of where you sit on the cap table and how everyone's ownership works out makes a ton of sense. But even I thought the really crucial point there was that it allows you, it like gives you optionality,
100%.
Right? And then that equity backstop is something that you can fall back on, especially if the company isn't going as well as you expect, which is not a conversation that you often plan for, but probably makes a lot of sense to like think about, especially in this environment.
And I think with honestly, AI and applications of legal costs will go down, for these sorts of things. Obviously with safes, why I say they're starting to look more like price rounds is everyone then comes with their own side letter and you spend more time negotiating your side letter and you're like, okay.
Yeah.
So
this is effectively price round rights with safe
totally
anti-dilution built in for the investors. And it's
and so it's starting to walk like a duck and talk like a duck anyway. So it just gives, again, the founders that position of leverage. Plus, I mean, let's be honest, auditors are going to start pushing more on safes.
Vis-a-vis QSBS, et cetera, or
more just the stale safe, right? Like how long has this safe been sitting out here for, with the expectation of conversion, right? Same with notes too. But that's another thing that we've seen from auditors, like they're starting to pick at those a little bit more. So we're sitting here saying, if you have the interest, meaning the volume of capital that you're closing, like take a little bit more time and you can sit back and sort of
do founders push back on that advice?
No, once they understand it. Right. But I think it's something where founders often, and I would do this too if I was a founder, go to my peers, right? What did my other friend who had a great close do? And what do you advise? And they're like, oh, just do this. It's really quick. Right. But it's seeing the long-term vision of what you're applying for, that's where we really want them to just understand that, okay, in venture, unfortunately, and startup land too, you have to think 4 chess moves ahead of what you're trying to optimize for. You're closing a seed round, but you need to think about what your Series A round and Series B round theoretically might look like. Yep. And so how can you get there with that? We have to do the same thing in venture. We're planning for fund. When we did fund 1, we did sort of have a storyline and a thought process around fund 3, which is crazy when you think about how long like that would be pushed out. But I think that perspective is what we try to force too.
Yeah. That makes a ton of sense. So anti-ducks, but pro-priced equity. Yeah. One tangent here. We mentioned AI a couple of times. How does AI as this everybody's thesis, it seems like at the moment, how does that fit into your view of like finding the change points along time? Is it something where obviously I'm sure it's in your investing theses in general, but how do you take this overwhelming thing that seems to be on everybody's mind and translate it into like a specific concept that you want to track?
Yeah, I think right now it's evolving, I feel like weekly. But yes, it's absolutely on everyone's mind. It permeates everything too. And it also reminds me of the storyline, again, when I'm thinking back to early 2010 around like the mobile first, strategy. How are we looking at what will mobile do? What's the application layer going to look like? And then same thing with the data science, I feel like trend and movement. I was at Galvanized Ventures before. We had a accredited program in data science. And that was something we were constantly seeing in 2014 through 16 was the application of data science and how is that going to then change your business model? And it was all the rage to be hiring, someone who had that skill set. So AI, I think, is moving in that same strategy. From a trend perspective, we believe it's going to permeate everything. But from an investment perspective, how are we making investments now against it? We've been taking time thinking about, okay, LLMs are one thing, but there's not necessarily a understanding of how the consumer will necessarily use LLMs consistently and their willingness to pay for. So I think that's a category where we're watching, but it feels a lot, I would just say sort of everywhere, but not necessarily a strong business model. One investment that we've recently made as a company called Composable, and they are looking at building a sandbox for automation for AI and manufacturing, so automated agents. So it's more along the lines of machine teaching, and it's a methodology around AI, which is fascinating, but it's one perspective. And that's something that we got very comfortable with because it's teaching agents how to use AI. And that's, I think, something that hasn't been talked enough about in this generative AI movement. I think that will be the next wave. Prompt engineering, is one thing in generative AI. Machine teaching will be the analogous for the agents in that philosophy. And then also thinking about it from a deep vertical expertise of knowledge. Who has that in what category? And how can AI apply advancements in productivity through that vertical expertise, right? And that also, I think, answers the big question of what's the business model and what's the willingness to pay. And right now, we as a society are not benefiting from switching costs. This is a first generation application of AI into our experiences. So we're not necessarily saying, okay, we're a business XYZ. We've already been using AI for X amount of years. We're going to go switch over to your
better,
business.
faster, cheaper.
Totally. Yeah. So there's the willingness to try, but is there the willingness to pay at the enterprise level? And we found that if you can be very specific on a very clear problem that you're solving for a one vertical, and that expertise, there is absolutely willingness to pay there.
Cool.
It remains to be seen if that will be sustainable over time.
Right.
But that's the thing where we're saying, okay, how do we as pre-seed seed investors make an investment now as the category is evolving? We don't have the luxury of being Series C investors waiting and watching and seeing who's the best winner.
Yep.
We have to make bets along the way. So it's like, who do we trust can build their own AI product
Right.
versus just leveraging LLMs and et cetera.
What percentage of the pitches that you get have some sort of AI component in them?
Oh my gosh, 95%.
Okay. So like basically everyone.
Yeah, but I mean, also like I have a portfolio that's 11 years old and I'm watching that portfolio evolve into AI, you
Right.
know.
They're adopting it just as quickly as the new
Totally.
startups are.
But some of those businesses are on Series D, you know, and so
Right.
they need something as well. And they're trying to figure it out within, you know, but I think there's a combination of like industry expertise. How are we applying AI? And it's more along the lines of just advancements of the data collection versus actually building in AI. They're just different things.
Yeah. So you spoke a little bit about the portfolio. I've been reading, you know, Jenny Fielding at Everywhere Ventures and the Series A Chasm that has been going on.
Totally.
How are you talking to your current portfolio companies? So you invested in pre-seed or seed rounds, and they're like, we're in again this sort of abyss, but for the Series A.
Yeah.
What are those conversations like? How do you coach them in terms of timeline and runway and like the sort of metrics that continually seem to be shifting under their feet, where they thought, I need X to get to A, and now I need 2X or 3X? Like, how is this possible?
Yeah, I feel like I'm saying this again and again, but it was the same thing in 2010 and 2014, right? You know, the benchmarks moved higher.
Mm-hmm.
It was a flight to quality. Founders, I think in this past, you know, downturn, if they raised in 2021, 2022, they had the benefit of raising a lot more than they would have in previous downturns. We haven't seen the deaths that I saw coming out from other downturns, you know, just the closures.
It's really weird because obviously the closures have been way up and we've put out some data on that.
Yeah.
But I completely agree. I think the amount of cash that people raised has extended out everyone's timelines. So there seems to be a glut at every choke point here in the venture scale, which is, I would have thought, we're 3 years or we're 2 years past now, like this would have resolved itself. But people made changes to their business and they raised a ton of capital.
100%.
And so they're still alive and still trying to make changes.
Totally. And so it pushes out a lot of, you know, false positives, if you will.
Yes.
You know, the J curve for all of the vintages are pushed out as well. Because exactly what you just said, there are no deaths in this, or there are some, but you know, they're not the extreme amount that we thought would be the swing in the other direction. So in terms of advice for founders of what they're doing across this, yes, I mean, it's everything from how do you cut your burn? How are you, you know, thinking strategically around making sure that you can live through this. But then it's the added unfortunate challenge of like, okay, you now need to make sure you absolutely have product market fit. And we know that Series A wanted you to have $1 million in ARR beforehand. Now it's looking like more like it'd be great if it was 5. Also, please don't have lumpy revenue. And a look through on the health of your margins and everything else. So all in all, it is forcing better products in market, but at the peril of, you know, you must do everything at once. And I also, later stage investors would like a very low valuation.
That would be great, yes.
And so it's having everything come together. So this is what I said before, is we want our founders to be in a position of leverage. And it's having those multiple conversations, multiple term sheets, which feels impossible right now. But it's just kind of going back to the basics of knowing what it is. The unfortunate thing, I think, on a macro scale of what we're asking, we as VCs and investors are asking founders to do, is to favor cash flow positive metrics and fundamental discipline at the, you know, risk of scale.
At the stage where perhaps they're cutting their future growth off.
And then do we then, if you're playing that out, have a series of small businesses on our hands as a sort of a generational movement, or not generational, it's unfair, but like, you know, a 2-year period where it's just a lot of small businesses that were created because we asked them to do X, Y, and Z.
But those won't return the fund.
100%. And so then do we have, and then you sit there and say, as you're looking at your, you know, fund, every fund has their outliers, their losers, the middle ground, but then is it much larger middle ground of smaller businesses? And then you think about the issues on M&A and acquisition and buyouts. And so then are we, venture, which is supposed to be the outlier category, just creating a bunch of small buyout opportunities versus like category creating. Right. And that could be the downside to all of this constraint that we're trying to foster.
Do you think that the flip side of that, which is the conversation that has come up continually over the last couple of months with me, is capital light, venture thin, whatever, take one round and then grow profitably from there? Is that the risk that I see in that is exactly what you just explained, which is you're creating a lot of wonderful businesses that probably shouldn't have taken venture capital at
100%.
all. And then the VC funds themselves are in between the rock and the hard place because they won't deliver the returns that the LPs are demanding because there aren't enough outlier ambitious companies.
Yeah. I mean, there's always going to be the outlier ambitious, but I think we're training a new set of entrepreneurs on behaviors that are actually not what we want in venture because it's a moment in time.
Right.
So it'll be unfair to turn around and say, okay, now step on the gas. I know I just told you for the last 2.5 years to be really cash conservative. You just built your entire company around that strategy, but now you need to move for growth.
You laid people off. You changed your software spend.
100%.
You did 1,000 things, and you did what we asked, and then we turned around and said that's actually not what we wanted.
100%. Yeah. I think to the founder that's thinking they're going to raise one round of VC dollars and then be cash flow positive, and then that's acqui-hire, which is fine. And I think there's a lot of businesses, but I think that's where it's hard to get on the road and path of venture capital. There's so much work in understanding the game of what you're fundraising for, how that business works in terms of VCs looking for XYZ. To sort of take yourself out of it seems like, why spend any time going in it at all?
Right. Yeah.
And I don't know that you'll necessarily be rewarded for the same. It's just different challenges over in different areas. It's a nice thought, but I think ultimately, again, if you're trying for scale, you need the venture dollars, but you sort of always, again, it's unfair. You have to say you need to be able to show that you can downshift into cash flow positive metrics. But yeah, I don't think that traditional VC will continue to push that.
It doesn't the model would have to radically change.
100%. Yeah.
And that's not what you raised the fund on.
No. So. And I just don't think, again, for the founder's best interest, this goes back to the founders really need to know who they want to take capital from and why. And it's educating themselves on the different partnerships, the different strategies. Right. And there may just be a whole another group of types of investors where it's more of a loan than necessarily investment. Do
you, on the side of pre-seed founders in particular, are you seeing right now that it is actually easier? You can build a business with less cash. It takes less money to build a company today than it did before. I hear that a lot, and I'm candidly a little unconvinced that that's true.
The cash moves around, right? I think it costs less to do some of the old things that, may have cost more, but your spend moves over in two different categories. There's two sort of major buckets that we always think about in terms of if you just raise capital. One bucket is talent, right? Yep. You have to hire the people who are going to help you build the thing.
Although fewer and fewer these days, it seems.
True, but at the same point, you still need a group around you to be executing on said vision if you're building a technologically defensible product. And then it's the second bucket is the capital to close customers. Yeah. And so when I think back to when I started in venture, there was a huge D2C movement, which was taking out the middleman. We were early in Warby Parker and then several other companies that sort of had that model. And it was advantageous because obviously buying ads online and Facebook, et cetera, were so affordable. Right. And you couldn't afford to create a four-wall business, although pop-up started because market was down and all this other thing. But there were these moments in time that you could take advantage of how you could spend to get eyeballs on things. And this is something we do at Hannah Gray, is we really start to think creatively around what are those interesting unlocks for your specific business now for, a period of time. They're not going to be true forever. And that's why you can never do the same thing twice because the metrics move, the market moves. But
everyone else has started doing that thing.
100%. So that's where I think the spend conversation of it definitely costs less, but what else costs more, right?
Right.
You're hiring individuals, but health insurance now costs an arm and a leg, like, to employ those people full time. And so there's just always sort of a new thing. You used to pay for servers, like now there's cloud,
your
totally.
compute goes up, et cetera, et
Yeah.
cetera.
So and so now if you're looking again at an AI company, the cost of leveraging AI to be able to build for AI, is a huge cost center.
Yeah.
And, you think about things where it's like, oh, okay, AWS credits or Microsoft credits, like those are available in a way that they weren't even, a decade plus at the frequency that they are now. So you can sit here and say, yes, it's easier to get started in certain areas, but other ones are just going to be your drains.
Totally.
So it just moves around.
Are these conversations around headcount or spend or just generally like how you build a pre-seed startup, especially in the go-to-market? Do you find that you have very different conversations when you're talking to founders from Silicon Valley and New York versus the rest of the country? Or is it really the markets have sort of converged at least to some point?
I think it's different across the country. I started my career investing in exclusively New York. In 2010 to 2014. And then 14, I worked at Galvanized Ventures and we were investing across the country. So then that was dramatically different around spend strategy perspective. Had someone come from Silicon Valley and then lived in Austin. And so then had I'd say perspective on something because they were sort of grown up there. And then Silicon Valley was its own animal. I think it's coming together more now than it ever has, but there's definitely a conversation. I think it's the DNA of the founder and where they came from. I remember backing one founder who just had a finance background. He was an incredible operator. And he could really wring out the finance towel, but at the potentially expense of, again, scaling the business.
Right.
Whereas I feel like Silicon Valley does a really good job of fostering the dream, and saying you need to go big or go home.
I don't think we're very good at wringing out the towel necessarily.
Well, and that's this perspective is like you do see, again, it depends where the founders are coming from. Did they work at big tech? What was their, operating background initially? And that really does inform their perspective on how they're going to build something. Right. I think we offer a perspective that probably leans a little bit more in that New York camp of like, show us the money, show us the revenue.
Yeah.
And it's nice to see that the market is starting to trend in that direction of like, yes, we all want to have the big dreams, but we also need to know that there's revenue to valuation disconnect, like is closing that gap.
Profitability eventually would be nice.
Yeah. And the public markets aren't going to take it anymore.
Yeah.
So I think that stuff, that perspective has to have some origin at the beginning. It doesn't mean that, and it's very hard to train in the opposite direction if you never favor, or you always just think there's going to be another giant round of funding that'll cover you.
Definitely.
It's harder to do that, but some founders get it done. So I think there's a meeting of, I'd say, the minds in terms of building the dream and building for the revenue.
Right.
In companies really anywhere, it's more just the DNA of the founder and what they feel like they can bring to the table.
Interesting. All right, so 3 rapid fire questions to wrap up here. Okay, first one. I was going to talk about sectors, but in your case, much more salient. What is the thesis that you are most excited about right now?
Oh man, there's a company
of many, of course. Yes.
Of many. There's one investment that we just made last week that I've been dreaming about for a while, and I'm so excited for it to have come to fruition.
Amazing.
It's in spatial computing coupled with neuroscience for augmented reality, which so if you're wearing the Apple Vision Pro right now, this technology allows you to actually feel things in augmented reality. And I'm watching your eyebrows go up.
Like a haptic system?
But it really taps into your neurons. Right. The team is a team of neuroscientists. They've been working on this for a while. I remember meeting them a year ago and just being like, I don't know what and where and how this is going to go, but it's definitely an edge case, and we understand the potential commercialization of it. But it feels very out there, and it feels very cutting edge. Their background is working with prosthetic limbs and building for prosthetic limbs, and so you can imagine that being the edge case of the extreme wanting to have touch and sensory.
Right.
And we are just thrilled because it feels as though we're really progressing and pushing the lines. And I think it was interesting with the Apple Vision Pro coming out with no handhelds because it forces movement in space with your fingers, which ultimately, that's what they're building for, which points to that direction. So I'd say that was a thing we were thinking about around spatial computing. We actually put something on our culture vibrations around it. We just didn't know what the application would be. And it was, again, being in that be ready state, finding a killer dynamic team, and then coming together and saying, this is going to be something that we know how to help in terms of finding customers and understanding the brand that could start to come around this, even though it's a B2B company. And it's called Afference. It's actually out of Colorado. And it's you.
It's a Colorado boy. Good stuff.
Yeah.
Love that. I love to hear that.
It's very exciting.
Fantastic. And then second question is most unique way that you or another fund that you know of has brought value to a portfolio company. So I know that this is kind of part of the Hannah Gray pitch. That you're going to do something very specific for them.
Yeah. I think we like to think of ourselves as just a bespoke support team. You can't, again, do the same thing twice for every company. There's definitely playbooks of, okay, this might have worked for one company. You feel similar. And so we could work into some of that strategy. I'm going to compliment Michael on our team, who just did an amazing support for one of our companies called Stand. They are a physical shoe company. Started out as a company, shoes for nurses, and they're moving into the standing profession. So anyone who stands for a living, needs better back support, et cetera. So it's anti-slip, it's antimicrobial. The margins are amazing. The founder is amazing, Rob Gregg. He had this vision. He is a passionate shoe guy from his core DNA. He's obsessed with the category. It's his second shoe company. He follows it like the Yankees. Like he's like, did you hear? It's awesome. Like
you're
listening.
like, no,
but I love that he does. And he had this vision where he wanted the new design for the Stand version. He wanted it to be designed by a designer who had worked on cars. And so he was really thinking clean lines, like a very specific look. And of course, on a startup budget, which is like, finding the needle in the haystack.
It's a unicorn in it.
Totally. Yeah. But seeing that challenge and being like, we think we can get a guy who can help you, and of course, Michael pulled a rabbit out of a hat and found him the guy. And the design is fantastic. Like you can Rob wears the shoes in the airport all the time. They're launching this week. And he just gets stopped all the time.
Awesome.
You can see how the design just communicates what it's supposed to. And that's something where it's really hard to we'll never replicate that again. Yeah. But it's just the point of like, we will go that far to help you find, what it is to realize the dream for the company. Cool. And our job as VCs, and I say this up and down the stack to, Series E and Angel, is like, we're supposed to be 1 or 2 phone calls away from solving the problem or helping you realize the vision. So we try to think about ourselves in that bespoke manner of how can we just lean into this random nuanced need that you have and try to get you the ungettable get.
Amazing.
Yeah.
That was one of the most unique pitches that I think I've heard in terms of a value add to a
it's so random
awesome.
And it's a little, it's non-technical, but it will define the future of the company,
and
which is
completely
like
inflects the thing,
100%.
Right? It's a left or right. Like
and it's fascinating watching the industry professionals in the shoe category. They see the design and their eyes get wide and they're like, who did this? Like, they know it and
game recognized game.
100%, and that's where I'm like, I'm so proud.
Yeah, that's fantastic.
Yeah.
All right. So last one is for any founders listening. What is the number one question that you wished founders asked you during a fundraising that many of them don't?
I think this is what I would do in the shoes of, and we do this to our potential investors. You have all the power as founders, right? We are middle money managers as VCs. You're building the incredible item. You're building the shoe company that's going to turn into the verb.
The next Nike. Yep.
Totally. And so you're the value creation. You need to have that leverage and you need to maintain that. So I say this as a question is you need to evaluate your investors with a very keen and critical eye. I think there's a power shift, unfortunately, that's always been sort of in the seat of the VC or the financier. And it really should be the other way around. And so I think founders need to come to the table with that critical eye of what is your business? We are a partnership here. We're looking to be, and we should be critically, I think, evaluated. And sometimes there's just an eagerness on the other side of, I love that there's a sharing going on, but it really should be like, what do you, Hannah Gray, bring to the table? And why would you be good for this? Why should I award you a seat on the cap table? Right. And so digging deep and understanding our business, because you're stuck together for a really long time and it for better or for worse. And so I'm bummed to hear stories about founders afterwards are like, this one's just not what I thought it was going to be, et cetera. And it's hard to discern that, but you can do it by referencing, and I just think there's an eagerness to close versus like understanding that this is a commitment.
What would you say to founders that today they kind of feel like, look, gotten significantly more difficult.
Yeah.
So my willingness to push back or ask more difficult questions may be lessened because I'm kind of fearful that like
Totally.
I'm 100 conversations in. Like, how many more of these do I have in me?
Yeah. But I think it's going with a very clear vision and plan for what is right for you and what you want. What are you going to say no to and what are you going to say yes to? And having that perspective going in, that becomes an aura and a feeling that, you know, they will self-select.
Yep.
And I think that's the fear of self-selection, you know, and saying like, I'm limiting my funnel, but being curated. Right. So I get it. And we've been in that same position where we're like, I don't even know if we're going to be able to, you know, get to our next milestone on fundraising, but it only awards itself because you're clear to your vision. And again, like, as we were just saying, the industry will recognize, right? Yeah. And you will leave people with an impression of, wow, he really knows what he's doing.
Right.
And that's what you want to be communicating versus like, oh, he'll just take anything.
Right. Yeah.
You know, and like, you shouldn't, you're building something wonderful.
Right. You're not limiting the top of the funnel. It's a thoughtful partnership with whoever you actually want.
Yeah. So have a plan, do your research, ask really thoughtful questions. And if they say no, be like, okay, given what I just told you, who in your Rolodex fits this?
Right.
You know, like, oh, never leave a conversation without asking for, you know, a freebie intro.
Amazing. Yeah. I was actually that's a great point. I was going to follow up on, when do you think venture stops being so positive sum? You know, you mentioned it's, you know, everyone likes to help everyone at the early stages. I think that's 100% true. I think to actually a pretty crazy degree. When do you think that stops?
When it becomes about a material ownership, you know, which happens sooner and sooner, right? But it really just depends on, I mean, when I'm in San Francisco and I just had a bunch of meetings, it's wonderful to hear like, oh, we're a VC firm and we're really friends with them, et cetera. But I think it comes down to like, you all have a business model. You need to own a certain amount of percentage, or you need to put a certain amount of money to work in order to have the model work. Yep. So it's pretty much when the model comes into play in its extremes and what will you or won't you do in terms of your exceptions. Right. So yeah, unfortunately, it's probably ownership driven, and that could start as early as the Series A board. Yeah. Like I must have 20% or 30%.
Right. Economics getting in the way of friendships.
Very sad. It doesn't mean we still can't be friends, but I think it's just that respect of like, we all have our own business models.
For sure. Mm-hmm. Kate, thank you so much for being here.
Thank you for having me.
This has been an awesome conversation.
Yeah, this was great.
We'll do it again soon.